Well, good afternoon. Thank you very much for joining us on Power Lunch. This is Bloomberg Quint and I'm Menaka Doshi. Let's get to the top stories at this hour. Indian markets continue to trade lower despite posting a minor recovery from early morning lows. Malvinder and Shivinder Singh are said to have taken out more than 500 crore rupees from Fortis Healthcare without the company board's consent. Walmart is eyeing a 20% stake in Flipkart and is willing to spend several $1 billion to acquire it. It's an earnings-heavy Friday as well, with six nifty companies, coming out with their numbers today. All right, let's start first with what else but the markets, of course. I think we're trading maybe around the day's lows with a very minor sign of uptick, but we're about 1.3% down, around a little over 1% down on the Nifty, and similarly on the Sensex. A quick check on how bond yields and the rupee are doing in the Indian markets before we give you a sense of what global markets are looking like. So that's the 10-year Treasury yield for you. We're around, I think, that 7.5% mark, or 7.4 rather. Rupee as well, around 64 is where I last checked it was. Dow futures and S&P futures showing some minor gains this morning, through the course of the morning, that is. So it might be indicating that, yesterday's deep cuts may not get repeated again tonight, but who's to say what happens in the next few hours. A quick glance at crude prices, which over the last 2 days have seen a considerable cut, and we're looking at now about $60 on WTI crude and 64 on Brent, as you can see, so down about 1% on crude. And finally, a quick check on gold, which is, of course, the safe haven, and see how that's faring right now in trade. Now, while you do all of that, let's talk a little bit about how Indian markets are faring, how vulnerable India is to the movement that's going on across the world. Neeraj is standing by to talk us through the morning's market action. Not as bad as we thought it might have been early this morning, and in fact there are a handful of stocks that continue to trade in the green, amongst them some defensives. Yeah, and actually if you look at a lot of stocks moving around, you would think it's just another normal day. Actually 1% down is just another normal day, to be honest, and volatility too, after shooting up substantially, has come off a little bit. Remember, it started off lower, VIX went up over 20, now at about 19.32, so even that is having a bit of a volatile session. But yeah, some defensives holding out, some pharma names holding out in particular in the session today. So IT is not exactly in the thick of things. HCL Tech is probably a lone ranger, but look at pharma again coming back and in the leaders list. So Lupin, Reddy, Cipla, across the board, pharma names we are seeing some gains, and commodities, particularly steel names. Tata Steel is up and active. SAIL after the numbers is up and active, and the top gainer on the mid-cap space as well. So that's doing reasonably okay for itself. I think the market, even in a scenario like this, is separating the wheat from the chaff, is giving its reaction on fundamental news. So Glenmark Pharma, despite pharma being in a good spot, is getting beaten down. Natco, after not the best of numbers, was punished 7-8% yesterday, still down about a couple of percentage points. So that's the other bit. And just keep an eye out on the volumes picture. Remember, yesterday, despite that bout of recovery, the volumes really didn't shoot up, but for the FNO because of the weekly FNO expiry, options expiry. In today's session, the volumes could be interesting, much lower than what we normally see. So the market has corrected a bit, has been volatile, but the participation is not as high as normally is around this time of the day. Okay, also on the downside, amongst the top losing stocks of the day, I think HPCL tops that list, largely on account of pre-earnings nervousness, I would imagine. Yeah. And then you've got a bunch of financial stocks, which is quite in keeping with what we've seen with the sell-off on Wall Street last night, which is when financial stocks, I think, took sort of the biggest knock on the back of rising yields across the world, and that's exactly what we're seeing play out in India as well. Yeah, and you rightly said, yeah, pulling down the Nifty bank as well. That's actually the top loser, but private banks participating. SBI was showing a bout of recovery yesterday. That's not as low as some of the others like ICICI, Axis and Yes Bank. Yeah, okay. So ICICI, Axis and Yes, all amongst the top losers in trade today. Now, this is not the first such sharp sell-off we've seen in global markets in this decade, right? Bloomberg reported that there were at least 9 such instances over just this decade itself, from about 2009 to 2018, in which we've seen such substantial cuts to equities on Wall Street. We've, of course, seen corresponding such cuts in India as well. So the question is, exactly how vulnerable is India to the movements on Wall Street? Jayesh Khilnani has put together some charts that give you a sense of how we move, whether completely in sync or not, with Wall Street. Jayesh.
So, Menka, we move completely in sync with what the US markets have done in the past decade. What we can see on the chart is the US market, which is the S&P 500, and on the top panel you have the Nifty index. This is a 10-year chart, and you can see that every fall in the S&P 500 that has been matched by the Nifty index, and every rise has also been matched by the Nifty index. So, largely in line with what the US market does is mirrored by India. Now, what we did was actually broke down some of the key falls in the US market that we saw. So that's the 2016 fall where there was concerns on the China slowdown, and we saw that the S&P 500 actually declined to the lowest since April 2014. But post that, the recovery was rather sharp, and it took about a month and a half to recover the entire process. And the Nifty on the top, you can see that too rallied from about a low of about 7,000 to 7,800. If we move on to another chart, sometime before. Now, that's the US versus India correlation. But if we can go to the other chart, which shows the China currency devaluation, so that is the chart that we have for you. So during this period, we saw that the S&P once again fell about as much as 10%, and it traded in a narrow range for a couple of months before recovering all of these losses. This recovery, mind you, was less than a month or so, and the Nifty also recovered to a similar extent. Going on to another jobs worry that we saw in the US, that too, the S&P actually fell about 17.5%, but during the same period, the Nifty was down only about 11.5%. There have been few other instances that we have captured. So this was one instance where the emerging markets, actually the stocks and the currencies in the emerging market space, that actually led the global fall. But the S&P actually declined to the lowest level since October 2013, but recovered quite sharply. This too was again just about a month and a half, the entire recovery process that we saw. So there have been similar instances where you have a zigzag move. Now this was the period in 2012 which was leading up to the US election. So you had a sharp fall in the S&P before the election, and post the election outcome you saw that the market actually again recovered. And a similar scenario can be seen for the Nifty, a fall followed by a rise. So these are some of the instances that we picked up where the global fall was matched by the Nifty, and the recovery also was matched by the Nifty. All
right, interesting. So we have a story up on Bloomberg Quint that details these 9 falls, sharp falls that we've seen on Wall Street and the recoveries thereafter. And the point the story makes is that each of these recoveries has been fairly rapid, and within a month or two, the losses have been compensated for in terms of the gains. And as Jayesh just pointed out to you, that is exactly how it's played out in the Indian markets as well. And this is just to give you some context to understand that as we continue to see maybe the same thing play out here in global markets, which is this big 10% fall that we've seen on the S&P in this week, if a recovery does take place over the course of the next few weeks or months, then you are likely to see the Indian markets mirror that in many ways. But let's get to the here and now. How are we faring against the cuts that we've seen in developed markets, but also relatively against other emerging markets? So Neeraj has some of that data, to give us a sense of where India stands.
Yeah, so one, where India stands, two, how the flow situation has been. I'll just add that piece as well, Menka. Okay. But this is, as of now, these are live market trades. And if you can see, the 13th index in the Asia Pacific region, I've taken Asia Pacific for sake of simplicity, that's the Nifty 50. That, until now, has corrected about 3% over a 5-day period. Now compare that to the kind of cuts that we've seen in the Hang Seng, we've seen in the Nikkei, topics across the board. Actually, you would probably then say that Nifty is actually one of the better performing indices. So the route across the world, India probably fares a bit better. The Sensex is not, actually the Sensex 32, if we just look at the numbers there, 2.5% doesn't really spook the investor. So actually an Indian investor should be thinking that he's probably a bit luckier than what the rest of the world is. Now compare that to the kind of flows that we've seen, a bit of a dichotomous picture, only looking at this week. These are the provisional numbers, mind you, and these are outflows. So Feb 5th, 1263 crores, 2,300 crores, 1,000 crores, 2,279 crores. So this week we've actually seen Friday, we don't know the Friday numbers as of now, but 4 days we've seen about 5,500 crores of FI money move out of India. Now you compare this to what's been happening across the world, and I have two charts. One is the ETF flows and one is FPI flows. Now on the ETF front, while China has received some money, India is right there at the bottom of the screen, $77 million. And the size of the bubbles shows you, right? I mean, there are inflows within China and certain other markets like Brazil, etc. India has got one of the larger outflows in the region. But, and of course, this is ETF flows.
ETF outflows.
This is ETF outflows. And then you move on to the next chart, it will show you the FPI outflows, which do not necessarily mean only ETFs, but active managers as well. And there, India actually is amongst the economies which has seen one of the highest flows. We're waiting for the chart to come up, I think. Yeah, the chart will just come up on your screen minutes from now. But if you sort it for week to date, India has actually been one of the large losers. Let's just sort it on a week-to-date basis right here. If we just click here, you will see. Just click here. Yeah. There, India at this position. There are other countries, South Korea, Thailand, etc., which have lost a lot of money. And I'll just corroborate this with the research that was done by Institute of International Finance. They put out a note on the 4th of Feb, wherein they've been analyzing how flows have been in the emerging market pack, and their analysis seems to suggest that Asia has been bearing the brunt of outflows, more so in the equities side, and India was not amongst the top countries until Feb 4th. That list was dominated by countries like Indonesia, Thailand, etc. Now, India is participating. 4 billion outflows happened till Feb 4th already. And now that situation has worsened too. So we're not isolated for sure.
Okay, but we still, in terms of losses, are not as badly off as many developed markets, of course, but some of the other emerging markets as well.
Oh, for sure.
According to you.
Yeah.
Okay, great. All right. Not all Indian equities have lost or sort of taken as big a beating in the last week as some others. So what Shraddha is going to do for us in the next few minutes is identify those stocks that have had a relatively better week.
That's right. So, since 1st of Feb, and why we chosen that date, because that's the time this sell-off, global sell-off started, and it also marked the budget day for India. So the benchmark indices, Nifty and Sensex, have lost about 5% since then. The Nifty 500 index has also lost about 5% or so since then. But despite that, you have 93 stocks out of that 500 in the Nifty 500 index, which have actually given positive returns since the 1st of February. We're not being able to pull up the chart, but
just shall we wait for a second, Shraddha, while I think they're having some trouble. Sorry, we're having some trouble with that.
Yeah. So here we have the trying to get on. So if you actually look at, if you customize the dates and select 1st February over here, you will actually see that there are about 93 stocks which have actually gained out of the 500 ones, which includes the likes of Religare Enterprises, Escorts, Avanti Feeds, Inox. All of these have returned more than 10%. Now, having
since
said
the budget day, you're saying?
Since 1st February, yes.
Okay.
That's the
so
time
you're counting the budget day in.
The closing of that day, because
fine.
It's since then that the sell-off started.
Okay.
So we have picked 5 stocks which have actually outperformed in this period, and the outperformance has been driven backed by a news trigger. So first one I want to point out is Ipca Labs. Now, it was the earnings beat that worked for this company. Net profit grew by 1.55%. EBITDA margins expanded by 500 basis points. In fact, you had the likes of Morgan Stanley and Motilal Oswal, which upgraded the stock. Second one is Ashok Leyland. Multiple triggers for this one. You had the budget push to infrastructure, which benefits the like of Ashok Leyland. Good earnings again, on the back of which you had some of the brokerages upgrading the stock, and a very strong set of monthly sales number in January as well, which worked for the company. L&T Infotech, again we saw earnings beat once again. Dollar revenue growth of 8.5% on a sequential basis, and 88% of the analysts tracking this stock actually have a buy on that name. The fourth stock that we're tracking is Bhushan Steel. Now, yes, that has managed to do really well. So a consortium led by GSW is set to have put in bids for about 25 to 30,000 crores was the liquidation value, which is said to have been set at 15,000 crores. So that's working for this one. And lastly, we again have Gulf Oil Lubricants. Again, it's an earnings beat, and they also have new capacities which have come on stream, which will actually aid volume growth in the future. So very safe to conclude that markets are rewarding earnings growth in such times. times.
All right, so these are the stocks you could have found some cover in what has been an otherwise rather volatile week. Now, where are global equities headed from here? What do you do if you're an Indian investor? Let's get you an expert voice. Andrew Holland, the CEO of Avendus Capital, joins us with his view. Good afternoon, Andrew. You know, there were two interesting comments that that struck me in the course of the conversations that we've done through the morning. One came, from Mike Levery, who said that what you're seeing play out in the market is not necessarily exactly correlated to the macro or rate situation. Thanks to passive investing in algorithmic trading or robo trading, you're seeing lower lows and higher highs over the last 2 years. The second point that came in was from Vikram Kotak, who said that maybe this is not the time to rush in as yet. What are you advising your clients to do?
So, first of all, I listened to some of the commentary before, and I found it very interesting that you point out that India is an outperformer, but it must be said that in the month of January, India was a huge underperformer, so there's a little bit of relativity there in terms of performance. So, we have to look over a longer period in terms of the figures. But that said, I think there's a few things, Monica, which is I think are important. One is, I keep reading that it's all about VIX and it's all about these exchange-traded products, but I don't think it's that. What's changed is basically that we're in an interest rate environment which is moving higher, and the market just didn't want to react to that for a very long time, and now it is. And, it's not going to go away from us. I think all the times when we've seen markets fall and then recover quite sharply is because you've had a central bank globally which has been very accommodative. And now they can't be as accommodative because, growth is really picking up, particularly in the US. We heard from the UK as well in terms of that interest rates could pick up, and the same in Europe. So something has changed. Now, I'm not saying that that's, will mean that markets continue to fall, but I think we're getting back to the reality is that, you have a central bank which is less accommodative, interest rates are moving up, and that means that different asset classes will become more attractive, and that will include bonds as well. So I don't think the volatility is going to go away for us in the very short term. I think it's still there. And I don't think, but I'm not overly bearish because I think the global economy is fine. Interestingly, again, over the past week, it's really been the markets taking the hit. It hasn't really happened in any of the commodities, apart from oil more recently. And you really haven't seen a surge in the gold price, which is usually 42 when for safety purposes. So maybe there's a little bit more to play out yet. But after yesterday's steep fall in the Dow, I'm sure people are looking at some form of recovery. But the VIX there remains quite high compared to to where it was a few weeks back. And I think if anything that has changed, and this is a big change, is that the bull market in complacency, which we've had over the past year because markets kept rising, has been thrown out of the window for some time. So it's that complacency, I think, which is being damaged quite a lot more than just the stock prices.
I get what you're saying, Andrew, about I think everybody having anticipated that this day was going to come, right? We knew that the easy money policies weren't going to stay easy forever. We knew at some point inflation would catch up, yields would catch up, and at some point people were anticipating that all of this was starting to get priced in. Ever since 2 years or 3 years ago, the Fed said that it was going to start reducing its purchases and then stop its purchases and then start contracting its balance sheet. At this point, given that we're about 10% down on the S&P, do you believe most of the inflation/rate increases in the US have been factored into global equity prices?
I think the excesses of the markets have definitely been taken out. But there's obviously worries around the kind of inflows that you saw in January in particular. The US, for example, I think got $80 billion in that month for equity funds. So, some of that will obviously, be hurting quite badly, and you have to see what they do. But, I don't think, possibly another 2-3% if that's going to happen on the downside. I'm talking about the Dow and possibly our markets too. So that's what I would say. I don't see very much more from here, because I don't see globally there's a factor to get extremely worried about. It's just really the excesses of liquidity-driven markets, which is being taken out.
All right, Andrew, I know you spared 5 minutes to speak with us. Thank you very much for that this afternoon. Andrew Holland, they're telling you that maybe a couple of more percentage points in the West and here in India as well, as the excess liquidity is taken out of these markets. Now, that was some comprehensive market coverage for you. Let's get on with some of the other big stories of the day, starting with this Bloomberg exclusive. Malvinder and Shivinder Singh, the two Singh brothers, are said to have withdrawn more than 500 crore rupees from their group company, Fortis Healthcare, without the approval of the company's board. Bloomberg News' Ari Elstera, who broke that story, joins in now from Delhi with the details on this. Ari, first explain to our viewers what you're telling them in the story, and then I'll come to you with a couple of follow-up questions.
Sure. I mean, basically our reporting shows is that the promoters of Fortis, Malvinder and Shivinder Singh, routed money out of the company through entities that eventually ended up with them, about 5 billion rupees. This caused the auditor, Deloitte, to refuse to sign off on the second quarter results, which delayed those second quarter results. And while the promoters, the two brothers, tried to figure out a way to get this money back in, so that they could move ahead with the results. They've since announced that Fortis will report its second and now its third quarter results on Tuesday. And just last night, after we contacted the Singhs to say we were going to publish this story about the withdrawn funds, the Singh brothers actually resigned their positions on Fortis's board just ahead of our story coming out.
All right. Even as you speak, Ari, we've got a comment or a series of responses coming in from Fortis. I'm going to summarize them very quickly. In effect, they are denying some parts of the story. They've said that, I think the total loan value is at about 473 crores, if I understand that correctly. The deployment of these funds was in the normal course of operations. They've denied that the auditors refused to sign the second quarter accounts. They said that the board will consider both the second quarter and third quarter results on February 13, and that the unit deployed funds in short-term investments. That's where the money was put to. So in some senses, Ari, they're obviously not in agreement with the suggestion in your story that this money was taken out of the company and diverted towards promoter group entities, as they are more frequently referred to in India. I want you to stay on with us, because we have two experts joining us to talk us through how they're reacting to this story. That's Amit Tandon of IIAS and J.N. Gupta, former executive director of SEBI and now founder of SES. And both IIAS and SES are proxy advisory firms and also look into issues of governance in India's listed companies. Amit, I'll start off with you first. Fortis has denied this and said that the funds were put to regular use. That may be something that's in dispute. But it is curious that their second quarter numbers were not approved. And while they claim that the auditor has not refused to do so, it's even more curious that second and third quarter are being taken up together.
Good afternoon, Menika. You're absolutely right. I think the promoters have found themselves in a pickle, not for the first time. It seems to be happening with remarkable regularity as far as they are concerned. Their answers which they provided at this stage seems to beg more questions rather than answer some of the concerns which the market players have had. The first, that it's highly unusual for companies to kind of look at two-quarter results at the same time. The second, when they turn around and say that, look, all the money was there in secured investments, I don't think that is an area of concern. The concern which was highlighted by your story, is the fact that, look, this money is actually showing in the company's books, but it's really not in the company's books, but has been moved out of from the company into certain promoter-controlled entities.
Yeah, fair enough.
And the third is, of course, that, look, if they believe everything is right and kosher, then why resign at this stage? I find the fact that, at this moment to cite something which had happened with regard to the Daiichi Ranbaxy transaction and saying the court orders have gone against us and we are resigning doesn't kind of fit into the timeline which you have described.
Yeah, Ari, did the company offer you any explanation as to why their second quarter earnings were not, sort of finalized, and why they've bunched the earnings of 2 quarters at one time?
They actually didn't address that point at all. We did put it to them, but they didn't address it. They didn't. A lot of the denials that they've put out in the statement, when we approached them, they didn't come with that to us. What they did do is they offered this explanation, highlighted by the previous speaker, as to, how the money went around and where the money really was. And we've included that in our story, but frankly, we stand by our reporting that money made its way to the promoters, and at the time that it was diverted out, it did not have approval of the board.
All right. And were you able to ascertain what that money was put to use for?
No, it wasn't clear from our reporting exactly what it was used for. I mean, obviously the financial situation of the Singh brothers is well known. They have a very large debt load at the holding company level. They've stated to credit rating agencies that they are working to pay it back through divestments and other maneuvers. They've had one default at that level. So, I mean, that's sort of the backdrop to this story, to this latest development. But in terms of what the specific funds that we found were taken out of Fortis, what they were used for by the promoters, it's not clear at this stage.
All right, Jay Gupta, what do you make of the details in not just the Bloomberg story, but the very fact, like I put to Amit, that they are looking at earnings of 2 quarters together, even though they're denying that the delay was not on account. The delay for the previous quarter, that's second quarter, was not on account of the auditor having refused to sign the earnings, as suggested in the Bloomberg story. They haven't explained, though, why they're running a delay.
Minka, first of all, I would say that there is some sort of a regulatory lacuna, because the companies can go to ROC and say that they are not going to, or go to stock exchange, that they are unable to publish quarterly results. My issue is there is that they should exactly say that what is the reason why they want to delay. If that is the case, then probably there will be more transparency. Now, coming back to the entire episode, now we have got 2 sides of the story. One says that auditor refused, the money went out of the company, and the other, the promoters are saying that no, money did not go, the results are not delayed because of this reason, blah, blah, all these things. Now, we as an investor, we as an analyst, really do not know what is the truth. But looking into the history, if you see in past what is happening in Religare, what is happening in Fortis, the story seems to be credible, and explanation from the management or the owners doesn't have to be credible. But we cannot say for sure what is happening. The other issue is this, that if you see, yesterday they resigned, and they say probably because of the Ranbaxy thing, and banks are not extending loan to Fortis also, we do not want Fortis to suffer. I don't buy that theory. The issue is very clear that somewhere something is rotting in the entire Fortis and Religare empire. And if you see, they have been doing transfer from one company to another company, investment from one company to another company. It is a mess. And if you see entire performance of the entire Religare group and the market capitalization that has come down, the story is very clear that something is not right there.
Okay. Ari, do you have a question for either of our guests before I jump in with the next one?
Sure. One for Mr. Gupta. What would you say is the next step for regulators at this point? Now that our story's on the wire, I understand that the Ministry of Corporate Affairs would regulate these areas of corporate governance, and I'm wondering, what are they going to do?
There could be multiple action, but the first and foremost will start from the stock exchange, seeking clarity from the company, what is that there. Then, if required, there will be investigation from SEBI, Stock Exchange, MCA, CSR office. But my point in all these cases is that in India, we have a system where any investigation and taking it to the logical conclusion is at least a process which will take a decade. And in this time, every money that has been siphoned off will be gone, and investors will be still not getting anything. So the issue here is this, that somewhere we have to ensure that if there is a fraud like this or if there is any siphoning of money, the first and foremost should be catch hold of that money and ensure that it is not distributed here and there further. That is the biggest problem. But the four agencies cannot simultaneously go against, that is the Stock Exchange, SEBI, MCA and SFIO. But who will do this and how fast they will move, it is a question which none of us have answers.
Even as we discuss this story, minutes after Bloomberg reported it, you can take a look at how the Fortis Healthcare stock is doing. It's up almost 17%, which is not typically how shares or stocks or shareholders react to stories which suggest that money was moved out of the company towards promoter, entities. I think, Amit, do you think that the market is reading not what is reported by Bloomberg today, but the fact that the two brothers stepped down from the board yesterday as a precursor towards the finalization of that very big deal that they've been hoping to pull off for several months now, which keeps making the headlines every now and then with the newspapers, but hasn't fructified as yet?
Look, just given the past pattern of behavior which we've seen, the issues with Ranbaxy, some issues which India Horizon Fund and IDBI trustee have raised with regard to Religare, while the market at this moment is reacting to the fact that the Malvinder and Shivinder are no longer associated with the company, it just might be a little bit too premature. And the reason I mention this is the fact that, look, after Ranbaxy got sold, Daiichi realized that they'd been sold a herring, and they actually then went into arbitration before they finally won in both with an award with the arbitrator and in the High Court here. The second thing you need to and therefore, you have a similar charge which has been made in Religare Enterprises. So I'm not sure whether, if the business gets sold, what you are able to do is you're able to alienate the brothers, but whether how much of the cash from the business is actually going to go out to shareholders, how much of it is going to remain here, and therefore is going to be kept for contingencies, etc., we don't know. So all I'm saying at this stage is the fact that the brothers may no longer be associated and this could be seen as a signal is a good thing. But I think this, the investors will continue to hear a little bit more about what has happened with the cash flows, some of the issues with regard to where the funds have gone, and the fact that there may be a hole which is a little bit larger than what is appearing at this stage.
Yeah, fair enough. Ari, one final question for you. Fortis has been on the block for a while now. Did you find out anything in your investigation into the story and in speaking with the people involved, whether they're anywhere close to a deal? Because when I saw the news last evening of the two brothers stepping down, I just thought that this was the final precursor before they're able to close that deal.
Right. Well, here at Bloomberg, we put out all the news that's fit to print. So anything else, if anything else I know, I guarantee you'll know as soon as we can firm it up enough to put it out in the world. As to the sale, I mean, that's obviously something that's been speculated about for a long time. Bloomberg, we have reported in the past that they are in talks. In fact, I interviewed Fortis's president some time ago, and he said that they were in talks. As for the state of those negotiations, currently, after the Daiichi verdict and after our story today, I can't speak to them. But I mean, we would like to find out, as I'm sure everyone else would too.
All right, we'll leave it there. Thank you very much, Arif, for joining us and taking us through that story, and to Amit and Mr. Gupta as well. I think it's worth pointing out to our viewers that, with these, these infirmities and the actions that have taken place at Fortis, you also have to remember that Religare has been through some similar tumult where both the chairman and the director resigned as the company was facing RBI scrutiny, and we've seen big management turnover there as well. So this does not bode well for either of the Singh brothers. But on that note, I'm going to leave it there. You can find out a lot more about both the Fortis story and the Religare stories on BloombergQuint.com. We're going to take a quick break. When we come back, 6 nifty companies will be reporting their earnings today. We'll tell you what to expect.
Nine to 5 job, अरे 5 to 9 job, भाग दौड़ all the time job. The roaming wala job, the deadline wala job, or are you living in the market wala job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
RP Sanjeev Goenka Group. Growing legacies.
हमारे पड़ोसी मेहताज हॉलिडे के लिए अब्रॉड गए हैं। हम कब जाएंगे?
उसके लिए पैसे कहाँ से आएंगे?
लेकिन मिट्ठू, इन्वेस्ट और उस पर इन शुक्ला जी की जिम्मेदारी छोड़ गए हमारे सर।
FDs में इन्वेस्ट करूँ क्या?
अरे मिट्ठू जी, आज के जमाने में इन्फ्लेशन के बाद FD रिटर्न से हाथ में क्या बचता है? ETF में इन्वेस्ट कीजिए, जिससे लॉन्ग टर्म में मिलते हैं स्टॉक मार्केट जैसे हायर रिटर्न्स, यानी इन्फ्लेशन का कम असर।
लेकिन स्टॉक मार्केट तो ऊपर नीचे होता ही रहता है।
ETF लॉन्ग टर्म इन्वेस्टमेंट के लिए बिल्कुल उपयुक्त है। ये देखिए, हायर रिटर्न्स, इन्फ्लेशन बीटर एंड नो टैक्सेस। ETF में निवेश कीजिए और देखिए हाथ में कितना बचता है। भाभी जी, जरा कोकोनट ऑयल देना।
ETF investments are subject to market risks. Read all scheme-related documents carefully.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Welcome back. You're with Power Lunch. Take a look at the headlines once again. Indian markets continue to trade lower despite posting a minor recovery from early morning lows. WTI crude continues its downward trajectory for the 6th day in a row, wiping out all the gains in 2018. It's an earnings-heavy Friday. 6 nifty companies are out with their quarterly numbers later today. All right, a quick check on how markets are doing at this point in time at 140. Agam, what do you have for us?
Well, the cuts on the Nifty and the Sensex are not as deep as the other Asian peers. That said, we're looking at the Sensex and the Nifty declined by as much as 1%. The India Volatility Index has moved up by as much as 9%, but this is only up and covered for the losses that we've seen yesterday. In the broader markets, when it comes to the cash turnovers, largely average, in line with what the average of the previous 7 days. On the other hand, when it comes to the F&O turnovers at 130, a lot less than what we've seen in the previous 7 days. The broader markets take support. In fact, the mid-cap and the small-cap indices have outperformed and, just trading marginally in the red. So with that, we're also looking at the realty and the metal indices, which have actually advanced in today's day of trade. And banks, on the other hand, private as well as PSUs, along with the NBFCs, have shown some amount of weakness. And I guess traders will take heart in the fact that losses in our own markets are not as deep as...
we like saying this every Friday. Thank God it's Friday. But man, this Friday, we really mean it, right? Yes. Given what a tumultuous week. And this was supposed to be the week where we got to chill out after the budget.
Yes.
And unfortunately, it just hasn't been the case at all. What with the market collapse across the world and the monetary policy, which also made for very interesting news. Agam, thanks very much for that. European markets have just gotten off this afternoon in terms of trade. Let's go across to Bloomberg's Ed Ludlow for a quick update on what's going on there. Ed, good afternoon.
Yeah, good afternoon. Yeah, so European equity markets have opened lower by around 0.3%. And if you look at the sector story, it's a bit of a mixed picture. Utilities down by as much as 1%, but financials, which people are watching closely at the moment, middle of the road, down by 0.4%, but nothing like the superlatives that we saw in the late US trading session yesterday. Of course, the S&P 500 erased its gains for the year, closed at a 2-month low, on track for the worst week since 2011. Dow plunged 1,000 points. And so Europe's waking up and asking what happened yesterday, and there's a great piece on Bloomberg, on Bloomberg.com, titled "What Just Happened?" Great story. There's a lot of discussion out there about the economics. Are we in late cycle right now? We spoke to Fed Kaplan yesterday. He said he was watching the credit spreads. Very interesting. I spoke to a credit investor yesterday. He said, in his view, there's an asymmetry between the credit spreads and where we are in the economy. If you look at credit spreads, they're low spreads. That indicates late cycle economy, fear of recession, right? And perhaps that's what contributed towards that sell-off yesterday. But other economic indicators are pointing towards a mid-cycle. So investors and traders here in Europe, there's a lot of notes out there from the banks about where we are in this economic cycle. PIMCO put a note out overnight saying the equity market behaviour that we're seeing is mimicking historical periods of accelerating inflation but slower growth. It's really that economic picture. But is there a flight to safety? If you look at what's out there this morning, gold is pretty flat. Look at the yen. It's actually weaker against the dollar by 0.4%. The US 10-year yield is higher by 2 basis points. This is similar to what we saw last week. Yields are going higher while stocks are selling off. Europe's still making its mind up. I just glanced over my shoulder. We're still lower by 0.3%. But as the day goes on, perhaps we'll understand more behind what traders are actually going off this morning.
All right, Ed, thanks very much for that quick update. That's how Europe markets have begun trade this afternoon. Now for an expert voice joining us on where this market heads next globally as well as here in India. Jim O'Neill, former chairman at Goldman Sachs Asset Management, joins us now. Jim, good afternoon. Thank you very much for joining us. 10% down on the S&P this week. Is it all priced in, or are we likely to fall further?
I have no idea about the answer to that, I'm afraid. Luckily, these days, I'm not professionally employed to have to worry about that every day.
All right. But instinctively, I'm sure you've managed to do the math and see whether you think that are we done with the losses, or are there sharper cuts to come?
So, what I think reasonably clearly is that until we get beyond the next US employment report and the next monthly wage indicator, there is no chance that this market will suddenly return to what it was like before. The thing that started all of this off, of course, is the beginning of fears that US wage inflation, and therefore with it overall inflation, is finally starting to pick up, meaning that the Fed will have to raise interest rates more than they perhaps even want to, and certainly more than was priced in. And because it was that event that started it, I think it would be very surprising if we completely stabilized again until at least we get to the beginning of next month. The other interesting thing in my mind this morning is, if you look just here in the UK, yesterday the Bank of England also made it pretty clear that they are now going to be raising interest rates perhaps a bit more than they previously thought, because of the same sorts of evidence in the UK. So the markets have to deal with the reality that finally, after this long period of, in some ways, almost 10 years, the most important Western central banks are all having to go into a period of thinking of raising interest rates at the same time. And it's perfectly logical, after such a massive rally in equity markets, that we have to reprice for a different environment, really.
But Jim, I'm sure the markets knew this was coming.
Well, markets sort of always live between greed and fear, right? And of course, everybody knew that one day this would come, but as we've seen happening, and now probably as part of what's unraveling, is because of the slow, steady nature of markets, you have all these so-called low volatility funds appear, and people assume that environment is the one to try and get the best yield out of, and that's the sort of greed bit. But you have to go through these periods where a more consensus or dominant new era comes onto the scene. The next thing that happens is people rush to fearing that it's all over and we have a new environment. And I think it's going to take some time for us to settle down. Obviously, some people will have this view that actually the whole of the past many years equity market rally is purely because of QE, and now we have the end of that, so we're entering a major bear market. I do not believe that myself. I actually think if you really look at the economic evidence in many parts of the world economy seems to be in a much better structural position than it's been for a long, long time. But that does mean we don't need the same kind of emergency monetary support that we've had for so long. And of course, I'm saying all of this with the ECB in Europe not yet having sent this same kind of message that we're getting from the US and the UK. And at some point, with the strength of European growth, we're probably going to have the market adjust to that as well.
Yeah, fair enough. I just wanted to know what you thought of whether the falls that we're seeing right now are exacerbated by both the kind of, algorithmic trading or robo trading, or even just the proportion of investing that now comes through passive investing or ETFs. Do you think that this would have been a kinder cut, keeping inflation and rates in mind, if it weren't for these factors?
Well, it's almost definitely the case that these kind of developments add to the size and speed of the moves, but it's important, in my opinion, to distinguish from that likelihood with two other factors. They obviously were also important aspects of the momentum when we've been rising too. And more importantly, the second point is, I don't think anyone should begin to go down the crazy path of attributing blame to those things as to why the markets are going through this phase. The markets are going through this phase because of simple, fundamental new economic developments. And if it weren't for the fears about the beginning of a pickup of inflation, especially in the US, I don't think people would be even raising the issue about ETFs and low vol funds. But they obviously have been a product of this very, very lengthy period of low volatility and people searching for never-ending ways of making money. Just as a silly example, somebody mentioned to me about an ETF for a small, so-called small cap companies the other day. And this is partly a sign of how far removed I am. I thought he was joking. I'm like, how can you have an ETF for something which is basically requires very careful stock picking? But apparently we do. And so I imagine there will be some fallout in the sheer number of ETFs that people have been rushing to dream up every other month as the bull market and the steadiness of it unfolded. But that's life.
Now, fair enough. You've looked at, many of these sell-offs over the last decade and more, and what impact they have on fund flows to emerging markets, especially markets like India, which is the eye in your famously coined BRICS or BRIC. How do you think India is going to be impacted in all of this volatility, given its own macro fundamentals?
So I think there's two or three things that are in my head in trying to answer that. One of them is indirectly related to what you said. What is interesting looking at all of this for me this morning is that actually China appears to be getting hit more than any other markets, which means there will be a new topic that no doubt appears in the discussions around Bloomberg and many other forums that actually does this also add to people's fears about China now, ironically, starting to slow down as many people have worried about for some years, just after a period where we're positively surprised. And that's an issue which is in itself of huge global importance, but obviously important for many emerging markets. Secondly, for India, of course, India as itself has had remarkably steady steady, persistent rally. And observing it from a distance on many weeks, it seemed to have taken place despite the fact India wasn't necessarily reporting particularly strong positive news. So India needed to have some kind of correction linked to all of this as well. The third thing, however, in the context of what you asked, obviously India historically has often been regarded as a better so-called defensive market because it's less dependent on global trade than many other emerging markets, particularly in Asia, but also elsewhere. So I would suspect India will hold up better than some other markets that link into global trade and global commodities in particular. But I think the idea that India would be resilient against the global trend of this magnitude for however long it carries on is unlikely to be the case.
All right, Jim, appreciate you joining us this afternoon. Thank you very much for sharing your thoughts. Jim O'Neill there, talking you through what he's reading into this market sell-off across the world and what it means for India as well. Now, we've got as many as 6 nifty companies announcing their earnings this afternoon. A majority of them belong to the energy space. So Somit standing by with a quick synopsis of what to look for in the oil and gas sector. Somit.
So I'll start off with the upstream companies first. In the third quarter of financial year 2018, it was mainly the higher oil prices and the gas prices that will be working for ONGC and Oil India. Now, if you see, the domestic gas prices were changed from 1st October 2018 and they were revised to around $2.89 per MMBTU versus from $2.49 per MMBTU, while the crude prices averaged around $61.4 per barrel in the third quarter versus $52.1 per barrel in the last quarter. So these higher crude prices with no subsidy sharing so far will result into a good result for the upstream companies in the third quarter of financial year 2018. For ONGC, if you see the headline numbers, the revenue is expected to be 24% higher, and this revenue growth of 24% could be the highest for the oil explorer in the last 25 quarters. Now, EBITDA is expected to be higher by around 47%. Margins are expected to expand to around 57% versus 48% reported by the company in the last quarter, while net profit is expected to jump by 19%. Now, the reason behind a slower growth rate of net profit is that the company is expected to report a lower other income and a higher tax expense in this quarter. For oil, on the operation side, if you see, the net realization is expected to come in at $61.3 per barrel in this quarter, which could be the highest in the last 9 quarters. On the production side, the oil production is expected to be flat at 6.5 MMT, that is million metric tons, while gas production is expected to be 4% higher to around 6.5 BCM, that is billion cubic meters. For Oil India, if you see the headline numbers, revenue is expected to be 15% higher to around 2,847 crore rupees, while EBITDA is expected to be higher by 19%. Margins are expected to expand to 42.4%, while net profit is expected to be higher by around 6% to 687 crore rupees in the third quarter of financial year 2018. On the operation side, the realization is expected to come in at $59.8 per barrel, while on the production side, the gas production is expected to decline, while the oil production is expected to be flat in the third quarter of financial year 2018.
All right, what about the oil marketing companies, HPCL, BPCL? In fact, HPCL is the biggest loser in this on the Nifty today.
See, Indian Oil Corporation had come out with a good result, but HPCL and BPCL are expected to report a muted set of numbers in this quarter. So if you see, for HPCL in the third quarter of financial year 2018, it was the only positive for HPCL and BPCL is the higher inventory gains, but the higher inventory gains will be offset by the lower refining margins and marketing margins in the third quarter. Now, the gross refining margin is expected to be marginally weak because the Singapore gross refining margin, that is the Asian benchmark, was also lower at around $7.2 per barrel in this quarter, while the gross marketing margin earned on sale of every liter of petrol and diesel by this oil marketing companies fell to around 2.3 rupees per litre and 1.9 rupees per litre from 3.1 rupees per litre in the last quarter. Now, this could be because of the Gujarat state elections we had seen in the third quarter of financial year 2018. In fact, the EBITDA and net profit of both the oil marketing companies, that is HPCL and BPCL, is expected to fall because of these two reasons. Now, the marketing segment would also be weak because of GST, because of the negative impact of GST and because of the digital discounts that the company had given. Now, if you see the headline numbers for BPCL, the revenue is expected to be 21% higher, while net profit is expected to be down by around 12%. This is wrong. It is expected to be down by around 12%. On the EBITDA front, it is expected to fall by around 7%, while margins are expected to contract to around 5.1%. On the operation side, if you see, the gross refining margin is expected to come to around $7.9 per barrel, while the throughput is expected to rise by around 3%. Now, this is because in the last quarter there was a planned shutdown of its Kochi refinery. That's the reason the throughput is expected to come in at 3% higher. Also, sales are expected to be 10% higher to around 10.8 million metric tons in the third quarter. For HPCL, if you see, the revenue is expected to be 22% higher. EBITDA is expected to fall by 14%. Net profit is expected to fall by around 14%, and the EBITDA is expected to be marginally decline to around 4.7%. On the operation side, GRM is expected to come in flat at around $7.6 per barrel. Throughput is expected to remain unchanged at 4.6 million metric tons, while sales is expected to be 8% higher to 9.4 million metric tons in the third quarter of financial year 2018.
All right, take a breath. Thank you very much, Samit. And the only reason Samit was rushing through that, as if his life was at stake, was because I'm sure some producer told him, hurry up, we have only 4 minutes to go on the show and a bunch of more earnings to round up. Rising steel prices and higher production in India is expected to aid Tata Steel in the third quarter. The country's second largest steel maker is expected to post a multi-fold rise in its bottom line. Nikki Michandani is standing by with the numbers to expect. Nikki.
Hi, Menka. We're expecting a good 17% rise on year-on-year basis for this company, and we're looking at a number of around 32,527 crore. If you look at the EBITDA, it's going to be a good operational performance for the company. We're looking at a number of 46%, looking at a 46% year-on-year jump at a number of around 5,100 odd crore. EBITDA margins seem to be fairly decent for the company, looking at 16% growth as compared to nearly 13% in the corresponding quarter of the previous year. Net profit, as you just mentioned, we're expecting a multifold jump there at a number of 1,400 odd crore as compared to nearly 230 crore that we've seen in the corresponding quarter. Now, consolidated EBITDA per ton, that's one key figure that we're looking at. That's expected to rise by 43% on year-on-year basis and 13% sequentially to a number of 8,275. On standalone basis, which is a key metric that we will keep an eye out, the EBITDA there is expected to rise by a good 13% both sequentially as well as on year-on-year basis to a number of around 3,820 odd crore. Now, higher realization and operating leverages are expected to percolate down well in terms of the margins of the company. If you look at the volume growth figure on standalone basis, we're looking at a 4% increase year-on-year basis at a number of around 3.1 million ton, which is on account of a ramp up of Kalina Nagar unit. And in terms of European unit, sales volume are expected to decline there by as much as 8% sequentially to a number of 2.4 million ton. Now, remember, that's a sequentially weak quarter that we're looking at least in terms of the European sales volume performance. Key things that we will keep an eye out will be the cost pressures of the steel industry, the price hike undertaken by the company, and also the progress on the merger with Thyssen Group, the actions taken thereon, and the planned expansion will be some of the other updates that we'll keep an eye out except for the results.
All right, we continue our breathless earnings preview commentary. Next up, Mahindra & Mahindra. Yatin?
Menaka, as far as Mahindra & Mahindra plus MVML entity is concerned, on a year-on-year basis, we are expecting a strong 12% growth in the top line. As far as the absolute EBITDA is concerned, we are expecting a 20% growth. Of course, the profits also would show a similar growth of close to 20-25%. Profits seen at close to 1,000 crores for the M&M plus MVML entity. Margins for the company are seen at 14.8%, a growth of nearly 120 basis points on a year-on-year basis. Of course, the key factors contributing to this growth would be a 7% jump in overall volumes, wherein the contribution from the tractor segment is expected to move up, and that will clearly support the margin growth for Mahindra & Mahindra. Also, the key issue was that the UV volumes saw a decline, and more importantly, the steel and aluminum cost for the companies, in the auto sector went up, and that will probably impact the overall margin scenario, and that is something important that we'll be watching out for. Apart from it, the management commentary on the new product launches lined up for the next 12 to 18 months, and also the outlook on tractor sales moving forward is important something that we'll be watching out for apart from the earnings.
Okay, Shraddha, you got 30 seconds. Key numbers to watch out for from State Bank of India.
Well, to start off with, Menika, the year-on-year numbers will not be comparable. The numbers that are reported because the merger of the associate banks and Bharti Mahila Bank became effective only on 1st April. So I'm just going to share the Bloomberg estimates. Net interest income is seen at 19,092 crores. Net profit is seen at 2,059 crores, but that would be an improvement from the September quarter net profit of 1,500 crores. Net interest income likely to be lower on account of dip in treasury gains and also absence of any extraordinary income. The second quarter had 5,400 crores worth of gain from stake sale in SBI Life Insurance. Loan growth is expected to be muted, and when it comes to asset quality, incremental stress will be curtailed, but credit costs are expected to be elevated. So watch out for RBI audit and any divergence, if at all, and of course the commentary with respect to that entire resolution. And there you go, Menka. I hope I completed in 30 seconds.
I think just about. Got to wrap it up here. Shraddha, thank you very much. We have you prepared for all the earnings. And up next is Countdown.